Hello, Super Saver. I hope you're healthy and well despite all that's happening in the financial world. So, what happens to your money if Schwab, Fidelity, Vanguard, or any one of the other leading brokerage companies were to suddenly collapse like Silicon Valley Bank? And we've seen how fast this can happen. Will your stocks, bonds, and other investments still be safe? And how will they actually be returned to you if Schwab, Fidelity, or the like were to fail? That's what I'll be talking about in today's highly requested SIPC deep dive on how to protect your hard-earned brokerage and retirement savings. And specifically, here are the 5 questions I'll be answering today. 1. What does SIPC cover? 2. How much does SIPC cover? 3. What if you have multiple accounts with the same brokerage company? 4. What is excess SIPC coverage? And 5. Which of the leading brokerage companies has the most of it? I've done a few videos about the SIPC already, but just to recap the main points, SIPC stands for Securities Investor Protection Corporation. It protects, insures the customers of brokerage firms against some types of losses, similar to what the FDIC provides for bank customers. So, when we talk about our checking and our savings accounts, these are protected by the FDIC. But when we talk about our accounts with a brokerage firm that we use to buy, hold, and sell securities, such as stocks and bonds, those are protected by the SIPC. It's important to understand that the SIPC protects you in that it replaces any missing cash and securities, such as stocks and bonds, in the event that your brokerage firm fails. However, the SIPC will not protect you against price decreases or losses in your investments. So, let's pretend that you have a brokerage account with make-believe brokerage firm Boomerang Brokerage, and you own 100 shares of Silicon Valley Bank in your brokerage account with Boomerang Brokerage. If Boomerang Brokerage goes bust and your 100 shares of Silicon Valley Bank are nowhere to be found, the SIPC would make sure you get 100 shares of Silicon Valley Bank delivered in your possession, despite the fact that Boomerang Brokerage has gone bust. What the SIPC will not do is make you whole for any price decreases or losses in your shares. So yes, in a hypothetical worst case scenario, Boomerang Brokerage goes bust and Silicon Valley Bank goes bye-bye, and then you'd have 100 shares of worthless Silicon Valley Bank stock. Nobody will make you whole for those losses on your investments. Of course, if you had 100 shares of Apple stock and they happen to be missing, you'd be thrilled to have SIPC protection because the SIPC will deliver you those 100 shares of missing Apple stock or what they were worth in cash when you filed your SIPC claim, which is clearly a good thing that will help you sleep better at night. Here's what the SIPC categorizes as a security and what it doesn't. An SIPC will insure the securities and only the securities and some of the cash, which I'll get into shortly. I know that a lot of the super savers on this channel have already seen this list. So if you're new to us, just pause here and have a look. And if we scroll down, we'll see that the list gets even longer. As customary, I've linked this page from the SIPC's website and the other sources referenced in this video in the description below. Because keep in mind, even if your brokerage firm goes bankrupt, and assuming no fraud has occurred, those securities that you purchased via your brokerage firm should still be in your brokerage account or held in custody somewhere with information attached to it that you are the rightful owner. If your securities have indeed gone missing for whatever reason, the SIPC will usually try to replace them first. And in the event that the SIPC cannot replace your missing securities, you'll receive the cash equivalent instead of what those missing securities were actually worth on the date that you filed your SIPC claim. Now, here's what SIPC does not cover. 1. SIPC does not protect against the decline in value of your securities. So as I explained before, if you had bought stock in Silicon Valley Bank via the make-believe boomerang brokerage, well, I'm sorry for your loss, but SIPC does not cover that loss in market value. 2. SIPC does not protect you if you're sold worthless stock or other securities. Think penny stocks. 3. SIPC does not protect against losses resulting from a broker's bad or inappropriate investment advice to you. So, that broker that sold my husband Marcus tips in a rising interest rate environment, tips that Marcus forgot to tell me he bought until recently and that have dropped significantly since the time of purchase, we can't get our money back from the SIPC. So we'll just have to hold those tips to maturity. The SIPC lady and I did have a giggle though when I shared this story with her and then asked if I could get my money back. All the major brokers we've talked about on this channel up to this point, such as Fidelity, Schwab, Vanguard, TD Ameritrade, Merrill Edge, and E-Trade, are all SIPC member firms. In fact, the vast majority of brokerage firms in the US are SIPC member firms, with a few exceptions. One of these exceptions is if the SIPC deems that a brokerage firm's business, including affiliated entities, is conducted outside the United States and its territories and possessions. And most brokers will list their SIPC membership on their website and or branch. But if you want to double check whether your broker is an SIPC member firm, just go to the SIPC website and click on List of Members. And from the screen that appears, click on the letter that your brokerage firm starts with to begin your search. Now that we know what the SIPC covers and what it doesn't cover, let's quickly go through how much the SIPC covers. As many of you already know, the limit of SIPC protection is $500,000, which includes a $250,000 limit for cash. This really needs more clarity because I've gotten so many questions about it. This Investors with Multiple Accounts page, linked below, gives a detailed explanation of how SIPC coverage works if you have multiple accounts with the same brokerage company. SIPC protection of customers with multiple accounts is determined by separate capacity, and each separate capacity is protected for securities and cash, $500,000 overall, including a $250,000 limit for cash only. Accounts held in the same capacity are combined for the purposes of the SIPC protection limit, and examples of separate capacities are listed down here. Let's walk through what this actually means for you and me with this table on how to calculate Jen's maximum SIPC coverage. Let's say that I have an individual brokerage account in my name with made-up firm Boomerang Brokerage. This individual account would have a maximum SIPC coverage limit of $500,000, including a maximum limit for cash of $250,000. If I then opened a traditional IRA in my name with Boomerang Brokerage, this traditional IRA would also have a maximum SIPC coverage limit of $500,000, including a maximum limit for cash of $250,000 for a total SIPC coverage at Boomerang Brokerage of $1 million, including a maximum limit for cash of $500,000. And if I then opened a Roth IRA in my name with Boomerang Brokerage, this Roth IRA would also have a maximum SIPC coverage limit of $500,000, including a maximum limit for cash of $250,000 for a total SIPC coverage at Boomerang Brokerage of $1.5 million, including a maximum limit for cash of $750,000. The reason for this is because the SIPC considers all three accounts as separate capacities. And if I'm so flush with cash, I'm not, but if I were, and I then opened a joint brokerage account with Marcus, so in both our names, this joint brokerage account with Marcus would also have a maximum SIPC coverage limit of $500,000, including a maximum limit for cash of $250,000 for a total SIPC coverage at Boomerang Brokerage of $2 million, including a maximum limit for cash of $1 million. Because again, the SIPC considers a joint account as separate capacity from these other 3 accounts in my name only. Do note that even though this is a joint account with both my name and Marcus's name on it, this does not mean that my SIPC coverage is doubled, unlike with FDIC insurance. Now, if instead of opening a joint brokerage account with Marcus in both our names, I opened a second individual brokerage account in my name alone, like this one up here, both of these individual brokerage accounts in my name would be combined, and I would still only be covered by SIPC up to a total of $500,000 across the both of them. Also, keep in mind that these are just examples of the accounts I could hold with this made-up Boomerang brokerage company. If I won the jackpot and used that money to open up an additional same 4 accounts with Backfire Brokerage, another hypothetical brokerage company, I'd basically be doubling my SIPC coverage. Anyway, if you want additional information on how this works, you can click on this link here from the SIPC's Investors with Multiple Accounts page that I referenced earlier. I've gotten quite a few questions about this as well. Excess SIPC insurance is designed to cover you up to a certain amount in the event that the security holdings and cash in your brokerage and or retirement accounts exceed the SIPC's coverage limit at an SIPC member firm, meaning this excess coverage would only be used as an insurance on top when the SIPC coverage is exhausted. Excess SIPC insurance is provided by a private insurer, not by the SIPC, and as I understand, is typically purchased at the discretion of the brokerage company. There is no legal obligation to provide excess SIPC insurance, although most major brokers do so. I'll start with the major brokerage companies that have the most excess SIPC coverage to the one that has the least. So, with that in mind, let's start with Fidelity, Merrill Edge, and E-Trade, all of whom have total aggregate excess SIPC coverage of $1 billion, meaning that's the total amount, the maximum that their excess SIPC coverage covers for all their clients combined. It seems $1 billion is the maximum excess SIPC protection currently available, according to Fidelity. So, $1 billion can be a lot if it's for a few isolated cases only. But it clearly would not be sufficient if one of these major brokerage houses collapsed completely and all the securities and cash were gone. That being said, according to the SIPC, in its history, less than 1% of claims filed were greater than the limits of SIPC protection. If you want more details on this, I've attached the SIPC's latest annual report in the description below. Okay, let's get back to this table on excess SIPC coverage. With Fidelity, there is no per customer dollar limit on coverage of securities, but there is a per customer limit of $1.9 million on coverage of cash awaiting investment. Merrill's excess SIPC coverage also includes up to $1.9 million of cash per customer, excluding any FDIC eligible products within the account. There was no mention on their website of a per customer limit, but if this is something that concerns you, I'd suggest reaching out to them directly. I did try calling, but after waiting on hold for more than an hour, again, I just hung up. E-Trade also did not provide any further information on their website besides the aggregate excess SIPC coverage of $1 billion. So if any of the E-Trade folks in our community have more information, please do leave a comment below and let the other E-Trade folks know. Schwab has a total aggregate excess SIPC coverage of $600 million. According to Schwab, the combined total of SIPC coverage and excess SIPC coverage means that Schwab provides protection up to a combined return of $149.5 million per customer, up to $1.15 million of which may be in cash. TD Ameritrade has a total aggregate excess SIPC coverage of $500 million. So, in addition to SIPC coverage, they provide each client with $149.5 million worth of protection for securities and $2 million worth of protection for cash through excess SIPC coverage. And finally, Vanguard has a total aggregate excess SIPC coverage of $250 million. They don't disclose too much detail on their website, and when I called in, Vanguard rep Megan had to put me on hold many times while she dug through her system to answer all my questions. She also told me that there was no website link that she could share with me, but in any case, per Megan, verbally, with Vanguard, there is a per client limit of $49.5 million for missing securities and $1.9 million for missing cash. I think what we can see from this table is that even with those lowest limits from Vanguard, it appears that the average customer at one of these leading brokerage companies is pretty much covered when you combine the SIPC's coverage limit with the excess SIPC coverage limits. So, hopefully, this will give you some peace of mind. All right, Super Saver, I hope this SIPC deep dive has answered the most pressing questions that you've sent our way. For those of you who are thinking beyond SIPC insurance, check out this video here on the top 5 money to-dos right now. It's what we've done recently post-SVB collapse with our own money as well as our clients' money to protect and grow our hard-earned savings during these uncertain times. And as always, if you enjoyed this video, then don't forget to share it with those you care about. And of course, hit that thumbs up and see you again very soon with another brand new wealth building video.